Welcome to The Explainer. We're skipping the long intros today because we need to jump straight into one of the most seductive, irresistible ideas in modern finance, the absolute allure of living purely off passive dividend income. It's kind of the ultimate dream, right? But today, we're going to pull back the curtain. We're looking at the raw data, the hidden math, and the harsh market realities that almost always shatter this illusion. Look, we've all heard some version of this ultimate investor fantasy. I want to earn $50,000 a month in dividends, not work, and just chill in the mountains. I mean, it sounds absolutely perfect. You build this magical portfolio, step away from the desk, move to the hills, and the cash just magically rolls in like a monthly salary while you sip your morning coffee. But here's the thing. How you actually construct that portfolio changes the story completely. Because honestly, there is a massive, massive gap between expectation and reality here. The expectation is that you just set and forget a high-yield dividend portfolio and live happily off the checks. The reality? Well, it's a pretty brutal crash course in macroeconomic forces. Relying entirely on dividends introduces a whole host of hidden variables that most investors completely ignore until it's way too late. So, reality check number 1. Inflation, the silent thief. Okay, let's dive into the math. Say you've managed to build a portfolio with a really respectable 4% dividend yield. On paper, that feels great, but you have to factor in inflation. If inflation is running at 6%, which is a pretty standard, realistic scenario in growing economies, your real return is literally underwater. Think about it. Your 4% yield minus 6% inflation means you're actually at negative 2%. Every single year, the actual buying power of your 50,000 rupees is shrinking. So a static dividend portfolio, it's just not a viable 10 to 20-year plan unless you actively account for this silent thief. Moving on to reality check number 2, the harsh reality of taxes. Because look, even if you somehow make peace with negative real returns, the government still expects its cut of your passive dream. Let's break down a super typical scenario for someone in a higher tax bracket. To get your magical 50,000 rupees a month, you'd need a gross annual dividend of 6 lakhs. But watch what happens. If you're in the 30% tax bracket, you immediately owe 1.8 lakhs in income tax. Boom, gone. Add on your health and education cess of roughly 7,000 rupees, and your total tax payable sits at 1.87 lakhs. Suddenly, your 6 lakhs of expected income is slashed to a net of just 4.12 lakhs. That 50,000 a month you planned your whole mountain life around, yeah, it doesn't exist anymore. Oh, and here is another brutal truth that honestly shocks a lot of first-time investors. Dividends are not paid monthly. Companies don't treat you like an employee on a payroll. You don't get this neat little deposit on the first of every month. Dividends are usually paid out as interim dividends or big year-end lump sums. This means that budgeting and managing your cash flow to simulate a monthly salary, that becomes entirely your headache. And wait, it gets better. Before the company even pays you, they deduct a 10% TDS, tax deducted at source. On 6 lakhs, that's 60,000 rupees held back instantly. But it doesn't even end there. If your non-salary tax liability exceeds 10,000 rupees a year, you are legally required to pay advance tax. So now you have to manually calculate and deposit your estimated taxes every single quarter just to avoid penalties. You went to the mountains to chill, but now you're literally doing quarterly corporate accounting. So what does this all mean? The crucial takeaway is this number, 2.8%. If you target a 4% yield and you're in the 30% tax bracket, your actual after-tax return is a measly 2.8%. And remember, that is before we even subtract that 6% inflation we talked about earlier. Which brings us to reality check number 3, the capital requirement trap. We've talked percentages, but let's talk raw cash, which is usually the biggest shocker of this whole explainer. To actually generate 6 lakhs a year in gross dividends, assuming you can even find a stable or liable 4% yield, you need an upfront capital investment of 1.5 crores. Just let that sink in for a second. For a relatively modest income of 50,000 rupees a month before taxes, you need 1.5 crores just sitting in the market. This completely shatters the illusion for everyday investors who think they can hustle their way into living off dividends with a small starting portfolio. And honestly, it gets even crazier. A 4% yield is actually pretty high, and it carries some risk. If you want to invest in truly safe, blue-chip companies with unshakable fundamentals, their dividend yields are usually closer to 1%. To get that same 6 lakhs a year from a safer 1% yield, you don't need 1.5 crores anymore. You need 6 crores. All right, reality check number 4. Stagnant prices versus actual growth. This is where we need to pivot from monthly income to true wealth building. Let's look at the actual historical performance of stocks that meet that high dividend, greater than 3% yield criteria. Here's a real-world example from our source data. Back in 2009, this specific high-yield stock was priced at 500 rupees. Fast forward to 2024, 15 years later, the price? 580 rupees. It has barely moved. Sure, you collected dividends along the way, but your underlying capital essentially flatlined for a decade and a half. And if you thought that was just a weird anomaly, consider this second example. In 2011, this high-yield stock was sitting at 400 rupees. Today, in 2024, it's at exactly 400 rupees and 65 paise. In over 10 years, the stock price hasn't moved a single rupee. Zero capital gains whatsoever. This brilliantly illustrates the fundamental why behind the problem. When a company makes a profit, they have a choice. A high dividend company takes that cash and simply hands it back to you, the shareholder. But that means they aren't using that money to reinvest in research and development. They aren't hiring better talent. They aren't expanding into new markets. Without reinvestment, the company just doesn't grow. And if the company doesn't grow, the stock price doesn't grow. Conversely, a capital appreciation strategy relies on companies retaining their earnings to fuel massive future expansion. Contrast those stagnant dividend stocks with a true growth stock from our data. Just look at this trajectory. In 2009, the stock was at 1,500 rupees. This company consistently reinvested its profits back into the business instead of paying out high dividends. By 2024, that same stock had skyrocketed to 11,200 rupees. Your capital didn't just grow, it multiplied exponentially. Which brings us to the ultimate paradigm shift, the power of CAGR, or the compound annual growth rate. Let's compare this over a 5-year timeline. If you optimize purely for a 3% dividend, your return is painfully linear. 3% multiplied by 5 years gives you a 15% total return. Nice, but nothing crazy. But what if you optimize for capital growth? Assuming a realistic 12% CAGR from an index, the magic of compounding takes over. 12% over 5 years isn't just 60%. It compounds to a massive 76% total return. That is nearly an 80% gain compared to a measly 15%. So with all this data, why do people still obsess over chasing dividends? The simple, honest answer: impatience. Impatience is the ultimate enemy of wealth. People want that payout right now, this year, today. And they let the desire for short-term gratification trick them into sacrificing massive long-term compounded growth. If you can't wait out that 5, 7, or 10-year period, you are leaving an unbelievable amount of money on the table. So as we wrap up this explainer, I really want you to take a hard look at your own strategy. Ask yourself, are you investing just to get a tiny, heavily taxed, inflation-eroded payout today? Or are you investing to harness the power of compounding and build true, life-changing wealth for tomorrow? The math is pretty clear. The choice, though, is entirely yours. Thanks so much for joining me on this explainer, and I'll catch you on the next one.